gonna start class. Bismillahirrahmanirrahim. Hello, hello student, all student, and all those here. The first, in the beginning, I would like to introduce Dr. Kamola. Bayram, she is assistant professor KTO, Karatay University, and education advisor, TKBB, corresponding IFN, Islamic financial trainer, type, awarded top 3 most effectual women in Islamic financial in 22 by Cambridge IFR. We would like to thank her for coming today. Okay, going to it, Dr. Kamola, thank you for your time.
Okay, can we start?
Yes.
Okay, thank you very much for your kind introduction, Doctor. And thank you very much for inviting. It's really an honor for me.
Thank you for coming.
So, actually, COVID-19 brought some good stuff to us. We can say that it is especially having this type of lectures, we can invite many renowned doctors. We're also doing same from other parts of the world or from different cities. So maybe this one is good side, advantages of COVID-19. We get used to digital teaching, online teaching. And Assalamu alaikum, everyone, students, dear students. And I'm really happy to be with you. We were discussing with your lecturer, Dr. Askar, that inshallah, maybe we can arrange things like I would love to see you in person in exchange programs. You will visit us here, we will visit you there. And let's say it will be a beginning. Well, this is your descriptive statistics class and you are finance and Islamic economics students. Especially when you continue your study, if you will continue your you will further your studies with a master's degree or PhD degree, this course is very important for you. Yeah, statistics courses, any statistic courses you are taking are very important because in future, if you want to conduct any analysis, you will need this knowledge you are gaining now. So please, I ask you to take this course, especially for very serious, and to learn as much as you can about statistics, okay? Because statistics, analyzing, knowing models will pave your way in future, okay? So my today's topic, actually, this is my PhD topic, guys, and we have 1.5 hours, right, Doctor? We have 1.5 hours for this class. Yeah. I will try to compact and give you as much as knowledge as I can. And I will also advise you a few papers, okay? And later you can refer to that papers if you want to know about the model. Today, our topic is Black Litterman model. Okay, we will talk about Black Litterman model and its role in identifying the optimal level of gold as a reserve asset for IC countries. As I told you, this was my PhD study, which I finished in 2017 in IIUM, Institute of Islamic Banking and Finance. And I was in Malaysia for 10 years. I visited your country few times, quite few times. It's a very nice country. I love Indonesia. Inshallah, we will keep visiting each other. Well, let me, like in every study in future also, when you will go for any study, you have to have a background. Like, when you are trying to do something, it means there is a reason you started this research, right? Let me tell you about my reason. What was the motivation for me to study the why it was so important for me to identify how much gold, an optimal level of gold as a reserve asset for central banks, why I was so much motivated and write about this, spent my 3 years on this topic and advise central banks on the level of gold. Well, I want to tell you maybe first about a little bit about my own experience in life. I was born in Soviet Russia. Do you remember these old times? We have Soviet Russia and Soviet Union. And, you know, The problem when you are born into a system, you consider this system as a default, like this is a ideal way of living and there is no other thing can exist in the world. This is how I was thinking that time. We have our currency, which is called Soviet ruble, okay? And my parents, of course, they have saving accounts. I have 2 siblings, we are 3 in total. So my parents have saving account, like your parents also, they were saving for us money for our future, for our education. And they saved enough for 3 of us to buy a house and continue our education, okay? Like this much they save. Now what happened? With the collapse of Soviet Union, Soviet ruble collapsed. Yani, the money which you are using now, for example, in Indonesia, you are using rupiah, right? Indonesian rupiah. Here in Turkey, we are using Turkish lira. In Malaysia, we use Malaysian ringgit. So the money which you believe it is a legal tender and has all power suddenly collapsed. You cannot buy anything with that money. Can you imagine? Yani, today, suddenly, the money in your pocket become invalid. This is what happened in Soviet Russia. And then all savings of my parents, which were enough to buy 3 houses, okay, 3 houses, they could buy only and only 1 dinner table and 6 chairs with all that money. Because why? The value of money collapsed. Money collapsed itself. Not only, it's not even inflation. It's suddenly the money is not valid anymore because country behind that currency not anymore existing. On the other hand, my grandmother, my late grandmother, she was born before Soviet times, and she saved all her money in gold. Whatever money she has, she will convert it into gold. And we see that after collapse of Soviet Union, collapse of Russian ruble, Soviet ruble, the price of gold start to rise very much. So those who were holding gold, they become richer. But those who were holding currency, normal paper money, they become poor, okay? And now here in this table, you can see the allocation, the price changes of gold for from 1973 up to today, 2021. Well, why from 1973? The question for you. Can I ask you questions, students? Is it possible to ask questions to students? Because this is important to know why we are taking gold prices from 1973 and why we don't have prior data. Okay, the answer will be this. You know the Bretton Woods system. In 1944, 44 countries were gathered in US, in New Hampshire, in Bretton Woods, in place called Bretton Woods, to establish a new monetary system. Actually, this meeting was about, this conference or congress was all about to introduce one international currency. And there were many, many ideas, proposals coming from Keynes himself, coming from different countries, but US, that time, they said that they insisted to have US dollar. Today, US dollar is international currency, right? It's international reserve currency. Wherever I go in the world, and if I have in my pocket USD, it will be valid, correct? It's kind of international passport, international currency. But since when it became international currency, when it gets this status of international currency, it was in 1944 after the Bretton Woods conference in New Hampshire, US. Well, in that conference, it was agreed that USD will be international reserve currency. Reserve currency means the money which we keep in our central bank, okay? They agreed on that. And why? Because US said, I have a lot of gold. At that time, there was 22,000 tons of gold, which US has. They said, I have a lot of gold. So if you make my money as a reserve currency, what I will do, I will back it with gold. So $35 equal to 1 ounce of gold. So if we take it roughly, it will be like one gram of gold is 1 USD, like that. Tamam? So since when? Until 1971, the world was on gold standard. Well, when you look here, before that, okay, the world was on gold standard. And starting from 1971, there is no anymore link with gold and USD. Why? Because once you link your money with another real asset, which is gold, you cannot print as much as you can, right? The term which we know as quantitative easing, when central bank prints money. Well, US was a time in war with Vietnam, and they need, war means financing. When you have war, you have to have a lot of money to fund this war, to pay your soldiers, to buy new weapons, to buy tanks, and so on and so forth. So you need money, you need funding. For that, the easiest way is to print money, right? In 1970s, US started to do this, because if you are in follow the standard which you are under, which is gold standard, you cannot print new dollars if you don't have new gold reserves. So US started to print money, and in 1971, some countries, starting with France, they said, okay, we have your US dollar in our central bank, and you are printing your money. We don't trust you anymore. We will send you back these dollars and give us our gold back. That time, what happened in 1971, 15 August, 9 p.m. US time, President Nixon give announcement. He said that, you can find this on YouTube, by the way, it's all available on YouTube. He said that, this speech is available on YouTube. He said, after this, there is no link between gold and US dollar, okay? My question, since it was my PhD study, I asked my professor, that time I was taking class from Professor Ahmed Maydin Kamil Mira in IIUM. I said, Prof, so, okay, US seized this link between gold and USD. Then why other countries, they didn't say, we don't want then your money, take all your USD back, we don't recognize it? Why they didn't say that? Why still whole world accepting USD as international reserve currency? Why? The answer was that before seizing the link, before cutting the link between gold and US dollar, US did agreement with Saudi Arabia that Saudi Arabia will not sell their oil to any other currency except USD. See, and that time we are living in industrialized world. We need petrol. All world needs petrol because there are a lot of factories. Now we have a lot of cars, and you need energy. And energy is in form of oil, petrol. So after that agreement, and since Saudi Arabia was producing at that time 90% of world petrol, it makes sense, right? As a country, you have to buy oil, you have to buy petrol, but Saudi Arabia is not selling you with your currency or any other currency, even not with gold. You have to pay in USD. See? So that was a very smart move, which US did. And we are still under this today. And since 1971, we call US dollar as petrodollar. It is another name of dollar, petrodollar. It gets its strength from this at the beginning, when it cuts the link between gold and USD. Now, what happened to gold? That's why I said, why we have data for gold starting from 1973. Because before 1973, from 1944 to 1971, okay, there was a link between USD and gold. It was fixed price, okay? And why we don't have data before 1944 because that time US dollar wasn't international money. So starting from 1944, US dollar is international money, reserve money, and starting from 1971, the price started to fluctuate. Why price fluctuates? Because US prints more money, yes. The amount of gold is stable, right? It is stable. You will, to get new gold, it takes a lot of effort. You cannot print gold as you like, but you can print paper money as you like. So see what's happening after 1973, price of gold is rising. And when price of gold is rising a lot in times of crisis, which means that, now I will link it to Black Litterman later on, which means that if you have gold in your account, if you have gold in your savings, yes, maybe during normal times, the price will not change significantly. And even maybe sometimes the price can go down. But whenever there is crisis, see here, 19th crisis, in 19th crisis, in 2008, today, after COVID crisis, the price of gold is always and always rising during crisis, financial crisis. That's why we said gold loves bad news. Okay, this is very much important for you as future economists and experts in finance to allocate your companies and your customers money, their portfolio in most efficient way. Tamam. Now, let's look at here why gold is so much important in the portfolio, because from my findings also prove this, but previous studies also said that gold has little or no correlation to other traditional or alternative reserve assets. What are reserve assets today? The reserve assets are mainly T-bills, treasury bills of USA, Euro region here, Euro, Yen, Yuan, and so on. Okay, this international money. So gold has no correlation or zero correlation. What does it mean, correlation? You know already from statistic course that correlation, zero correlation means if the price of one asset changing, it's not affecting the price of another asset. In other words, if you are, for example, let's say, for example, what the easy example to give you. Let's say you have some money, okay? You get your pocket money from your parents and you wanna avoid the inflation, and maybe you change some amount in your pocket, let's say to USD. So you have Indonesian rupiah, you have USD. So what happened? Actually, what happened in Turkey, for example, because Indonesia and Turkey, we almost have same dynamics when it comes to economy, right? So look, for example, the price of USD is growing, which means that once the price of USD is growing, the value of your national currency, of your local money is depreciating. So there is reverse correlation, right? If one is rising, then another one is falling down. So the ideal, of course, to have assets in your portfolio which have negative correlation. So if one is falling, let's say you have a few stocks in your portfolio, okay? So one company's, while one company is raising, another company's price is going down. Okay, this will give you warranty that you will never go to lose. Okay, one is growing, another is falling. If one is raising, another is falling. Okay, but even better to have assets which has no correlation. Okay. The diverse drivers of gold supply and demand are independent of and in many cases opposed to the forces that determine the value of other assets. This makes gold an effective diversifier that can have a significant positive impact on portfolio performance. Now, again, I was studying this. I give you example of from my family, right? For example, if my parents, they don't put all their money in currency, in Russian ruble, but if they have a bit gold, like they have half of their savings in gold, they will not become financially collapse, right? That was a mistake. They didn't allocate. Okay. Now this example only for my family. Now we are looking at countries. Okay, like in my study, I study 4 countries. One is Turkey, second Malaysia, third Saudi Arabia, and 4 Pakistan. I look at reserves of these countries, see what I find. See, first let's look here. This is gold reserves and percentage of gold in the reserve in some other countries. In USA, today USA has 8,132 tons of gold, which constitutes 75% of the total international reserves. This is for USA. Second, European Central Bank has 502 tons, which constitutes 32% of reserves, okay, of central bank reserves. Germany, 3,000, actually Germany number 2. Germany has 3,395 tons of gold, and it makes 71%, almost 72% of their reserves. And Italy, same, 71%, France, 71%, Switzerland, 14%, Netherlands, 60%. As you see, the majority of their reserves of these countries are in gold, not in paper money. But let's look at some Muslim countries. Yemen, Tunisia, Bangladesh, Morocco, Indonesia. In Yemen, Yemen has 1.6 tons of gold, and it makes only 1% of the total reserve, which means that 99% of your reserves in Yemen is what? Currency. Which currency? International reserve currency. What is international reserve currency? It's US dollar, mainly US dollar. Of course, we have few other currencies which are identified by IMF as international reserve money in CDR basket. But when we look to Indonesia, Indonesia has 78 tons of gold, and it makes nearly 3% of their reserves. Okay, which means 97% of your money you keep in US dollar. Now, what's the problem? What can happen? At the beginning, I told you what happened to my family, right? Once country collapse, because paper money, what does it mean, paper money? Paper money has power as long as you have the country backing it, right? If the country falls, like in case of Soviet Union, money will fall. Tamam? So this is what happened in Soviet Union. So what, now question, what will happen today if, let's say, US economy will fall, will collapse? Yeah, US economy will collapse, and suddenly US dollar will not have any value. What will happen to our reserves as Muslim countries? We don't have Muslim country which has more than 5% of their reserves in gold. Do you know that? Compared to USA, 75%, 32, 71, Germany, 71, Italy, 72, France. See how much gold they have and how much gold we have as a Muslim country. So that was my motivation. I said, no, we have to do something about this. We have to, as academician, we have to work on that. Now, here I also have Russia's central bank gold holdings in tons. See, from 2000 up to date, Russia is one of the countries who is increasing their gold holdings. Another country doing this is China. By the way, in China, it is a national call to buy gold. Why do you think? Because China knows that the day when US dollar collapse is not that far. Okay, and actually this table says a lot. What does it mean? That price of gold going up. When price of gold is going up, means the value of US dollar is going down. It means that there is more printed USD in the market. Tamam. So now, this is during Bretton Woods. How the balance of central banks look like. So it was store of value was gold, and they have USD just for operational needs. What happened post Bretton Woods? Once we cut the link between gold and USD, now we have USD a lot. It's like back up a country's domestic currency, and we even proud to show that how much USD we have in our reserves to show the strength of our country, right? It's same for all developing emerging countries. For Indonesia, for Turkey, for Malaysia, we have same standard mindset. And we have a little bit gold. See how the pyramid changed from that time to this time? Well, now, as I said, the purpose of my study was to identify what are the factors that determine the price of gold. We are not going to cover because I use 3 methodologies in my study. This one we are not going to cover. What is the opportunity cost of holding gold in relation to stock market? I was using Garch model. This also we are skipping. It's not today's class. And the last one, to identify the optimal level of gold to be allocated in official reserves. This is what we are going to cover. Okay, now I'm telling you, guys, see, it is important to have gold, right? But now question, how much? Okay, how much of gold? Now, even as an individual investor, I'm telling you, look, for example, I'm telling to your lecturer, look, Dr. Askar, you need to diversify your portfolio. You need to have, yes, normal savings, but you need to have also some gold. Now, the answer to how much gold, what will be the ideal proportion of gold in my portfolio? This is a question. How I'm going to find it? I can find it empirically by using models for asset portfolio allocation. Okay, what are these models? Let's look at them. Okay, this one, okay. Significance of the study, tamam. I already told you, some literature, we're not going to cover this. Well, now we are going to identify the optimal level of gold. Before, let's look what type of models we have in asset allocation. The first model we call mean variance approach. This approach was developed by Henry Markovich in 1959. Okay, and we know this as a modern portfolio theory, or MPT. Let's look. The allocation of foreign reserves is traditionally achieved by utilization of Markovich mean variance approach. It was very famous model in using for portfolio allocation. This approach views the portfolio as a whole, and the optimal allocation of assets is based on the general expected return and risk. So I took assets into my portfolio. I have few assets, okay, asset A, asset B, asset C, like, and I'm looking at the return, and I'm also looking at the risk. Then I'm also looking at the risk appetite of the investor. If your risk appetite is high, I will bring assets which has high return, but also has high risk. Okay. If your risk appetite is lower, if you are not very risk, if you are risk averse investor like me, for example, I consider myself as a risk averse investor, then you will look at assets which has low level of risk, but of course, if low level of risk, you will have also low return. From my personal experience, since I'm doing this study, I started my PhD in 2013. I finished in end of 2016. Of course, after doing all this, I started whatever extra money I have since then, when I start to work, I put it in gold. And I can assure you, like from my own personal experience, that your savings will only grow, especially during time of crisis. It can be any crisis. It can be financial crisis. It can be health crisis like COVID-19 today, right? So take it as a As we say, we don't give, of course, it's not consulting, it's not consultation, but take my experience. It's my experience. I'm sharing with you my experience, okay? Well, however, the method is not sufficient to lead central bank managers to information on how to invest external assets in a multiple goal way. Modern portfolio theory, MPT, it's same name, like mean variance approach, and MPT, modern portfolio theory, Markovich model, it's named for the same model. Tamam? It's based on a diversification of assets. So yes, we are diversifying assets. We have portfolio and we are putting few different assets into that portfolio. Investors likely to minimize the risk and maximize the profit. Any investor, as investor, we want what? We want a maximum profit with minimum risk. By including assets that are not correlated to each other. So the key word here, that we need to find assets which has no correlation, because if the assets are correlated, if the price of one asset will start to fall, all others will follow and all your portfolio will collapse. So you have to identify such assets which has no correlation, okay? Even one is collapsing and another asset will perform independently. Tamam. So how Markovich himself explains this model, he says that if security returns not correlated, diversification could eliminate risk, okay? As I told you, if you have in your basket assets which has no correlation, then there will be lower risk of default. It would be like flipping a large number of coins. We cannot predict with confidence the outcome of a single flip, but if agreed many coins are flipped, we can virtually be sure that heads appear on approximately 50% of them. To reduce risk, it is necessary to avoid a portfolio whose securities are highly correlated with each other, okay? So the key word here, if you are asset manager, if you are portfolio manager, tamam, what you should do, you have to identify assets which has no correlation with each other, because once you have securities which are highly correlated, it means your portfolio is vulnerable to risk. Yes, when price is going up, all portfolio, you will have very good figures, but once the price of one asset going down, all others will follow to collapse. Tamam? So the mean variance approach benefits the investors by building a portfolio which reflects the level of risk tolerable for the investors. Another interesting thing, as I told you, in mean variance approach, yes, I'm asking you for the level of your risk. Are you risk averse investor or you want to take a high risk? So according to that, I will give you different combination of assets. Maybe I have same assets, okay, but combination, the weight of each asset in the portfolio will be different. For example, if you are risk averse person, you don't have much appetite for risk, I will put a bit risky assets in your portfolio, in your basket of assets, and more assets which has very low risk. But if you are risk averse investor with a high risk appetite, then vice versa. I will put in your basket more assets with high return but high risk also, and less assets with low risk at the same time with low return. Accordingly, the portfolio manager, define for each asset. Now, three things manager have to define for assets in this model. First, the expected return. Yes, I will give you the expected return. I will tell you that if you now have these assets in your portfolio, you can expect to get this return in the future. By the way, I have to tell you that in finance, there are many models for expected return. There are a lot of models, but you should know that finance is such a world, especially today, it's so volatile. Rarely these expectations will be met. But another thing, maybe you as new generation can consider, using AI, machine learning technologies, data science, big data analysis, which give you more accurate predictions of assets price moves, okay, in the future. So just keep it in your mind. And maybe some of you will try to develop, extend this Markovich model to another levels. Now we will move to Black Litterman, because Black Litterman model is another step in Markovich model, okay? So now the manager can identify expected return of the portfolio, risk indicators, and correlation with other assets. Following the individual analysis of the assets, the investor can estimate various weight combinations. So various weight combinations according to your risk appetite. So if you have high risk appetite, I will give you totally different combination of assets. If you have different, if you, let's say, have higher risk appetite, I will give you totally different basket with same assets. Come on. So to define the profitability for a particular level of risk. To decide on the optimal portfolio, the investor should determine the most optimal set of relationships between risk and expected return that founds on the efficient frontier where all possible efficient portfolios take place. So what is efficient frontier? This is efficient frontier of Markovich. You have risk tolerance. Here we have low risk, it's going higher and higher and higher. And here you have rate of return. See, if you have low risk, your return will be like, if your risk appetite is here, your return will be this much. If you have higher risk appetite, like until here, then you will have higher return. Okay, so and all these portfolios who are tangent to the frontier are optimal portfolios. It means that with this level of risk appetite, the optimal portfolio for you is this. And for this level of risk appetite, not here, not here, not here, not here, but here. This is the best portfolio for you. This is what can Markovich portfolio theory, the modern portfolio theory of Markovich, give you as an asset manager or individual investor. By the way, guys, you can implement this model yourself. You can go to YouTube, right? Type how to implement this model. You can, no need even for software. You can just use Excel. And there are many videos on YouTube which will show you step by step how to use Markovich model, Black Litterman model. Please use them. Yani, internet now is your really number one, I would say, helper in the studies. Well, after this, there was a lot of criticisms for Markovich portfolio theory. Okay, they said, okay, this is good model, but in real world, it's not working. Why? It's not working. Let's see what some scholars mentioned. For example, Michaud said that besides Zera criticizes that even tiny changes in expected return may result in the substantial reallocation which derives a less satisfactory factors. It means that very small, let's say you have only two assets, asset A and asset B. If there is a very small change in return of asset B, suddenly all allocation will go to asset A. Another problem here, when you are calculating the expected return and when you are building your new portfolio, the only things you are taking into consideration is what? The historical performance of your assets. It means how good or bad was that asset in the past. Okay, this is the only thing. You are not looking to future. Another scholar said that the higher level of risk aversion is resulted in too much weight given to an asset with a lower volatility rather than in diversification of a portfolio in a great number of less correlated assets. See, it means that if you have, if you are risk-averse investor means your risk appetite is very low. You don't want to take risk. In such cases, what this model will do for you, it will put almost all your savings into asset which has low volatility. It means that price is fluctuating very small. Okay. Meanwhile, what he wants to do to give portfolio with less correlated assets. So instead of doing this, the model is putting all your money into asset which has very low risk. Brand et al. Described the theoretical limitation of the mean variance approach. According to the author, there are 3 shortcomings of the model. So first shortcoming is expected utility maximization. The framework implies quadratic utility, which leads to a preference specialization problem. Second, the higher order returns are not considered due to second order approximation of expected utility maximization. And third, mean variance approach cannot manage real world investment problems. This is the biggest problem, because once you develop a model, it should be implicable in real world, okay, for what you are doing this model. But again, Markovich developed this. However, it was further developed by who in 1991, Fisher Black and Robert Litterman. Okay, now we are moving to Black Litterman. So Fisher Black, and this is from where the name of Black Litterman model is coming from, his surname Black and his surname Litterman. Okay, so Black and Litterman, who were working at the time, see, they are not pure academicians, by the way. Markovich, yes, he was academician, but these guys, Black and Litterman, they were working in Goldman Sachs. They were who? They were practitioners. So they were working in Goldman Sachs, and they presented Black Litterman model. By the way, model was presented in 1991, okay, and they never give you step-by-step implementation of the model. Yes, they show you the model, but if as a researcher or as a manager, portfolio manager, you want to implement the model, you cannot. Why cannot? Because they never give you how to do this. Until 2004, one scholar named Itzorek show you how to do this step by step. And I use this paper to do it in my PhD. You can find this paper on internet, okay? If you really wanna work with this model, this gives you perfect step-by-step guidance how to implement Black Litterman model, because it's a sophisticated model. And you really need to know how to do. So in 1991, the model was introduced by 2 practitioners in Goldman Sachs. The model is an upgraded version of Markovich's mean variance approach. So again, I want to highlight here that Black Litterman model is not brand new model. It is improved version of MPT, of modern portfolio theory. Okay, or Markovich's mean variance approach. The Black Litterman model helps reserve managers to overcome key shortcomings of mean variance approach, such as lack of intuition, the input sensitivity of a portfolio, and high concentration. Okay, so we say that in Markovich portfolio theory, what was happening, you only take into consideration the past behavior of an asset, then tiny changes, the allocation will go to less risk-averse asset, less risky asset, depends on your risk appetite, of course, and so on and so on. So it doesn't have any intuition. What does intuition mean? Intuition is when you feel, okay, maybe this asset was performing very good until today, but you have feelings that in future something will happen, economy will change, and this asset will go down, or vice versa. You may see there is an asset which was not shining very much in the past, but as an investor or as a portfolio manager, as a finance expert, you have intuition, you have sense that in the future this asset will grow, like what's happening in Bitcoin or cryptocurrencies, right? So maybe most of us were thinking that, oh, this asset is nothing, no. But some people, they have intuition, no, there is future in digitalization, there is future in this cryptocurrency. So let me put, again, when you are doing investment, guys, never put all eggs into one basket. You have to separate them. You have to allocate them into different baskets. Tamam? So some people say, let me put some tiny amount of my savings into this, and they become, how to say, in recent years, they become very rich. This is intuition. This is what we call intuition, because there is no historical data, reliable historical data for cryptocurrencies performance, right? And especially today, we have over 10,000 types of cryptocurrencies, for example. Which one? Like, we know only few. So a new expected return vector is derived by using the Bayesian paradigm, which pulls views of an investor. So now I also add into the model views of the investor or portfolio manager related to the expected returns of a single asset or multiple assets, known as absolute view and relative view respectively, with the market equilibrium vector. So what I can do now in Black Litterman model, I can have absolute view, which is on one asset. I can say, yes, I have gold in my basket, and I feel, see here, I put my feelings. I feel, I think, I predict, is totally my intuition, that in future there will be such a crisis, and definitely the price of gold will go up. This is first thing. This is example for absolute view. Another is respective view. I can say, I can compare two assets. I can tell you that, look, let's say gold will outperform USD, okay? Something like that. Now, what I'm doing, I'm giving you a relative view, or Indonesian rupiah will outperform Chinese yuan, for example. Renminbi. I always mix yuan and yen. Tamam. So this is relative example for relative view. Thus, used along with an allocation process, the Black Litterman model originates portfolios which are more diversified and more balanced. So now you are reaching to a portfolio which is less, how to say, which is more in line with the real economy, okay? The Black Litterman model, however, is a sophisticated method which is not easy to replicate. Again, see, the model is very difficult, but the implementation of mean variance approach, for example, is explained in details in Markovich explained in his work in 1952 how to implement model, because once you know the model, it's very important, especially in statistics, to someone to show you step by step how to implement the model, what type of data to put, which is step 1, which is step 2, what is step 3. Markovich explains it, but in Black Litterman, they didn't explain. As I told you, up to the first study describes step-by-step application is Edzorek 2004. See, after how many years the model was, you were able to replicate the model. So again, guys, if you are very much interested in the model, you can just download this paper. It's even if it's in Word format. You can find this on internet. Just write Edzorek 2004, Black Litterman, step by step. You will find it. It's free to download, and you can implement. It's very interesting model. Now, again, since we are dealing with intuition, right? We'd say that now investor or fund manager is adding his own view. As an investor, I'm telling you, oh guys, you know that gold will raise 20% this year. This is my view. There is historical data, yes, it's reliable when you do prediction relying to historical data, but now I'm giving you my own opinion. It's my opinion. So that it means it's human factor here. When we talk about human factor in finance, we have new, not very new actually, it's also started in 1990s, relatively new, relatively newer, more new compared to the conventional finance, one discipline called behavioral finance. Did you hear about behavioral finance? Because it's also one of the areas of interest for me. Behavioral finance shortly says that normally in economics discipline, we consider that human is homo economicus. Who is homo economicus? Is a person who wants to maximize his profit and minimize his risks, right? Yeah, if you are you are rational, you always maximize your profit, you always measure things, but a real study shows that no, people are not rational in their decisions, especially in finance. We are influenced by many factors, and behavioral finance will identify them. It can be mental accounting, and one of them is most important is overconfidence. As an investor, I can be overconfident, okay? And I can tell you, like confidently, yeah, it will grow 20%, I'm sure, 100%. It's overconfidence, because never ever you can be 100% sure about the future of financial, in general about future, and especially about the future move of financial assets, right? So overconfidence and Black Litterman model, now we also have to consider this. It means now we are moving to the nature of human being. It's not only pure numbers. We are dealing with the nature of person. And here we talk about effect of behavioral finance in the Black Litterman model. So what happens with overconfidence? Overconfidence is one of the most researched and recognized concepts of behavioral finance. And this section, in this slide, we will shed some light on the impact of overconfidence on the Black Litterman model. It is known that the reserve manager is required to allocate a confidence level. Now, once I told you, I think that price of gold will rise 20%, I have also tell you how much confident I am about this. 50%, 60%, 10%. What's the confidence level about this? Okay. To his views on the future performance of the asset in the portfolio, which is expressed in the form of interval change from 0% to 100%. 0%, it means that I told you something, but I am not sure at all about that this will happen. And 100% means certainty, right? In probability theory, you know, 0% means impossible event. 100% is certainty. Yani, I'm telling you that this is the only way. Yani, this will certainly happen. Okay, that the price will rise by 20%, 100%. So once you are giving your view as a portfolio manager, you have to identify also how much you are certain or you are sure about this view. The literature review introduced above has shown that investors are prone to be overconfident. By the way, there are many studies done about overconfidence between genders. Do you know that, for example, investors, male investors are more confident compared to female investors? And they continue their study with comparing how marriage affects. Women, they are less confident as investment. I'm talking about the investment, okay? They are less risk-taking and less confident before marriage. Once they get married, they become more confident on investments again. But males, they are more risk-takers, they are more confident before marriage. But once they get married, the level of their confidence is going down. Interesting, right? This is findings on investment behavior between genders and marital status. Well, and in many cases, overconfidence may lead to bankruptcy and to the willingness of the investor to take high levels of risk. So it's a problem when you are highly confident, when you say, yeah, this is going to happen 100%, there is a very big risk that you will get bankrupted because of your overconfidence. What is overconfidence? Overconfidence when you don't look at your strengths, at your knowledge rationally. you overestimate yourself. You think that you know everything. Okay, you read maybe just one paper and suddenly you make decisions related on that paper, and you think that, yes, you are right, 100% is going to happen. So this is also very risky. Please be careful when you are doing investment. Therefore, it is a natural to ask if implementing the investor's view into the model will help to derive a better performing portfolio, or the overconfidence of the investor may lead to a poor performing portfolio. So yes, we say that now we are adding views of the manager into the model, but what if the manager is overconfident? It will damage the portfolio. So actually here, what we do, we have to, okay, make sure that we are dealing with the professional, especially in reserve allocation. Well, now let's move to Black-Litterman model itself. Fisher and Black-Litterman were motivated to further develop the mean variance approach due to the shortcomings encountered while implementing Markovitch model. In practical portfolio management, added the fact that the approach has not had a crucial impact in practice. Actually, it wasn't used much in practice. Yes, it was good model for understanding portfolio allocation system and for academic work, but in practice, no. So they developed new model, as we said, and in 2004, we were able to replicate it. The authors tried to derive improved portfolio models by introducing a new approach in predicting expected returns. Meanwhile, the portfolio required to be at the efficient frontier. So efficient frontier, again, I show you, right? Before, in previous slide, it is a frontier, and you have this portfolio, possible portfolios on that frontier, which means that it will be the best portfolio for the given level of risk. So, if this condition is oversaw, then by using mean variance approach, it is possible to derive a better portfolio. Therefore, it should be noted that the Black-Litterman model is not a novelty, as I said you before, but the improved version of Markovitch model in terms of calculating expected return. So it's not new model, totally new model. It's just one, like let's say you have car, and now you have a new model of that car, okay, with a few more features like it has camera inside, it has different view, okay, maybe it has touch screen, it has different some features, but the model, it's just an improved version of the old model. Same for Black-Litterman model. It is improved version of the Markovitch model. As a result, the portfolios derived using Black-Litterman model differ substantially from those generating using Markovitch model, but the results of the portfolio will be totally different because what you are using Black-Litterman model, you are including the views, future expectation. Let's look here. As a natural starting point, the Black-Litterman model uses equilibrium returns. Equilibrium returns are calculated using either the KPM or a reverse optimization method, in which the vector of implied expectant equilibrium returns pi is extracted from known information. Using matrix algebra, one solves for pi in the formula. So pi equals to lambda times sigma times W. So what is lambda? Lambda here, risk aversion coefficient, okay? Risk aversion coefficient means how much risk the investor wants to take. Sigma, fixed covariance matrix. So covariance matrix is various covariance matrix of assets. And W is a vector of market capitalization weights. Now, what we do? The Black-Litterman model was developed to make portfolio modeling more useful in practical investment situations. The formula, this is a formula of Black-Litterman. Again, there is softwares you can buy to implement, but you can implement this model. Okay, you have all your data. you can do this using Excel, guys, okay? Don't underestimate the power of Excel. There are so many things you can do using Excel. And how to do, you can find on YouTube. Please, if you want to implement this model, you can go to YouTube. So what is ER here? ER, new combined return vector. So how we find it? T is a scalar. It's assumed as T equal to 1. Sigma variance covariance matrix of all assets under consideration. P is a matrix identifying which assets an investor has viewed about. So I have, let's say, 10 assets inside my portfolio, but not necessarily I will add view on each asset here. Maybe I will have view only on one asset, on 2 assets, or I'm comparing 2-3 assets, that's it. Okay, so not necessarily you have to add view, like you have stocks in your portfolio, you have, let's say, sukuk, you have gold, you have other currencies. Not necessarily you have to give view on each single asset there. No, just what you think important. It can be only one asset. You can compare the performance of 2 assets in the future. And P times T is transpose of a matrix P. Omega, uncertainty surrounding views of an investor, or certainty. Pi, implied equilibrium access vector, which we calculated before. And Q is views on expected excess return for some or all assets. Okay. Now, let's come to my study. Now I'm studying the reserves of 4 central banks. I want to tell them what should be the optimal level of gold in that portfolio. Now I need view, okay? Of course, I cannot reach the portfolio manager of central bank. No portfolio manager of central bank will give you view because it will be a very big risk. So what I did for my study, first I look at the performance of some assets during global financial crisis of 2008. I look at Japanese government bonds, treasury bills. What happened? They fall down. I look at US government treasury bills. They also fall down. I look at UK government bills. They also fall down. Same with euro, which means that they are correlated. One is going down, all of them going down. Then I look at gold price. The gold price rose. Okay, it rose up to 1.5%. Meanwhile, other assets dropped. So now, looking at this table, what I'm doing, I said that view 1, my view 1 was gold will outperform US denominated securities by 4%, okay, in the future. So I can look here. I can just consider looking at this table that in future, the gold will outperform by 4%, and my confidence view is 50%. Not to make it 100 or 0, I just took my confidence of view 50% for both of my views. I have 2 views in total. Second view, so this is absolute view. I'm giving, sorry, it is also relative. I'm comparing one asset with another asset. I'm not telling you that gold will rise 20%. No, I am telling you that gold will outperform other asset, which is US dollar, by 4%. Second view is Great Britain pound denominated assets will outperform Japanese yen denominated assets by 100% points. 100% basis points means 1%. 100 basis points means 1%, okay? So again, I have a relative view here. I'm comparing 2 assets and my confidence level is 50%. So see what happened after that. When I implement the model, when I put everything in one pot and cook, see what I get. Here you see what the current portfolio of Central Bank of Turkey, of Republic of Turkey. Okay, we have this one. We just consider that it's like that. Normally, most of the assets reserve assets, Forex is held in USD. So here, when we look at gold, gold is here, we have 16% of gold, right? Today in Turkey. So we have Japanese yen, US dollar, Great Britain pound, we have euro, and we have gold. So when we look at the current portfolio, this is current portfolio. The most of the assets held in US dollar. And yani, in general, all of them, 3%, Japanese yen, US dollar, Great Britain pound, euro, all of them are currencies, foreign currencies, okay? Which has very close correlation. So they are moving together. Once one go up, all of them going up, once going down, all of them going down. They are correlated positively. Then we have 16% of our savings in gold. Now, once I implement the model and I also add my views into this model, what I got was this, that we need to reduce our USD holdings from current 60% to less than 40%. And we have to increase our gold from current 16% to 36%. More than double gold holdings. Why? If we want to have efficient reserves, okay, which can withstand the crisis. Another country, this is for Turkey. Another country is Malaysia. So this is for Bank Negara Malaysia. So current holdings of BNM, again, see, most of them are foreign currency, Forex, which is USD and other claims of different countries. Again, you can get, once you visit central banks' balance sheets, they are, you can find them on their websites, on their official websites. Of course, no country will give you a table like this, chart like this, that we have this much USD, but they will give you how much in total they have Forex holdings, okay? Then I use some another models to divide them. So not necessarily this represents the real balance sheet of central bank, Malaysian central bank, same for Turkish central bank, same allocation of for Forex, foreign reserves, but 100% I can tell you that for how much gold they have, it is clear. Like currently Malaysia's reserves consist 99% in Forex exchange and 1% of gold. Okay, so 1% of gold, knew what we calculated after we put all information in Black Litterman model. Our new suggested portfolio is like that. You have to increase your gold holdings in Malaysia from 1% to 27%. So it will be optimal level of gold. Because again, when you talk about optimal level, it is not something that, okay, yes, invest in gold, but how much gold I have to buy? Or what's the optimal level? What's the best to hold? So for Malaysia, we find that from 1%, it should be increased to 27%. And US dollar holdings should be reduced to 40%. Same for Turkey. Do you remember? Let's look at Saudi Arabia Monetary Agency. For Saudi Arabia Monetary Agency, Saudi Arabia also has 99% of their reserves in USD. It's normal because Saudi Arabia is selling their money in their petrol in USD. So yes, we have these claims in Japanese yen, claims in euro, but I consider, of course, no one give you item by item allocation of reserves, but I think that in Saudi Arabia, especially, it should be 99% of US dollars, okay, since they are selling their petrol, which is main income for the country, in USD. As I mentioned earlier, after Bretton Woods, right? Why? So if someone asks you why Saudi Arabia has to sell their USD, their petrol, their oil for USD, the answer is there is agreement in 1971 between US and Saudi Arabia that Saudi Arabia will sell its petrol only and only for USD. In return, USD will guards them, keeps them from other problems, like, okay. So for Saudi Arabia, we have same numbers. So the reserves should be foreign reserve, like USD reserves should be reduced to 40%, and gold should be increased to 27%, 27 times. And last country is Pakistan. In my study, you can implement the same model for Indonesia. I really highly recommend you. And for Pakistan, State Bank of Pakistan, they have 11% in gold, and it should be increased to 33%. This is a gold figure. This is figure for USD. 61% of their reserves are in USD. And in general, it is 89% of the reserves are in Forex, paper money, okay? And from 61%, the reserves should be decreased to 40. So you see, for all 4 countries in my study, the US dollar reserves should not exceed 40% of the whole balance sheet. We are overholding US dollar paper money, and we don't have enough allocation to gold. All Muslim countries, this is one of our common mistake maybe. And again, the question, what will happen today if US dollar will collapse? Can you imagine all our savings, our national money will melt down, will collapse? And when you look to other countries like Russia, like China, they're aggressively increasing their gold reserves, okay? So that was my motivation. Of course, here, conclusions of my study. So we say that our analysis of IC Central Bank foreign reserves showed that allocation to gold is very negligible. 5.9% of total world gold reserves for Muslim countries. In this thesis, we took 4 OIC member countries as a proxy, namely Malaysia, Turkey, Kingdom of Saudi Arabia, and Pakistan. For all countries except of Pakistan, gold acts as a safe haven during times of financial turmoil. Okay, that was other part of my study. Now, maybe I also mentioned to you, it will be beneficial. What is safe haven asset? And what's the difference between a hedge asset and safe haven asset? Hedge asset, in finance we divide assets, right? So hedge asset is the asset which overperforms other assets during normal times of economy, of finance, of economic, in finance. But safe haven asset, which don't overperform other assets during normal time, maybe it's even works less, but whenever there is crisis, any turmoil, it will jump, it will overperform. As I told you, gold loves bad news. So some investors, they make mistakes. They buy gold in normal times. Now we are not in normal times. We are in turmoil, you know, this health crisis. So before that, we were kind of stable, and the price of gold, time to time, it will drop. And people say, okay, I bought gold, but it's not, I'm not gaining anything. But once we get crisis, this recent health crisis, it's made its new record high for gold. So gold loves bad news, and it is safe haven asset. Why? Because in normal times it will not shine, but once it is bad times, times of crisis, it will shine with all its beauty. The price will fly and fly. Okay, you will become double, triple richer. However, despite of this fact, our analysis suggests that actual gold holdings are below the optimal gold holdings. This is for all 4 countries. I'm sure we will get same result for all countries, Muslim countries. This thesis recommends to increase unofficial gold holdings to the optimal level obtained by our analysis, or higher even, to build a balanced portfolio which will preserve its value in times of financial crisis. So this is my study. Here are some advices for your future study. Maybe if you want to do your master's or PhD, you can refer here. I will share with your lecturer, and you get from your lecture the slides. And terima kasih banyak-banyak for your time. It was very nice for me to be with you today. And if you have any question, I think we have time for Q&A, right? Dr. Askar.
Yes, we have 10 minutes, around 10 minutes. Okay. If anyone, first, thank you very much for your sharing and your experience and your important point. Already is a benefit for us today. We shall continue to study about the subject to focus about the problem of Islamic countries. It's a really big problem. And
Yes.
so going ahead about this subject and non-stop. Really, because it's subject so important for the future of Islamic countries. Okay, thank you very much for you. And any one of participants have a question, he can ask or she can ask, and we take the experience and benefit from Dr. Familia when you have time with us today. Okay, anyone have a question?
Yeah, it was honor for me. I'm really happy, and we have almost 80
Yes.
participants. You told me you have 20 students. Mashallah.
Yes,
I have a
but
lot
we're
of
sharing all of students and participants.
Thank you,
Your
everyone.
experience, yes, we share to all. So they coming to
Thank you very
get
much.
benefit. Yes.
Thank you.
So we see there any question.
You
Okay.
can ask any. Okay, there is, I think, one in chat, right?
Yes, you see. If there are any.
Hello, thank you for your wonderful lectures. I want to ask about, is there any possibilities that the world will use cryptocurrency as a recognized legal tender? Actually, there are studies towards it, to use cryptocurrency, I think, but at the first stage in Malaysia, I was attending a lot of meetings, a lot of forums, like which were organized by the Central Bank of Malaysia, BNM, on this topic, and they were talking first on digital currency. What I think that from my experience, from what I attend, what I listen from the experts, that at the beginning we will move to digital currency. So what's the difference between digital currency and cryptocurrency? The digital currency, it is money which still have power of government behind it, okay? But when we talk about cryptocurrency, actually cryptocurrency is a blockchain technology. And why it was initiated, they want to have a money which will not have any authority behind it. So it will be all about blockchain technology. So can it be legal tender? We will see. Because if it will become legal tender, yeah, digital money can become legal tender, but crypto money, can it become legal tender? For me, it will be contradicting the initial aim of introducing this type of currency, cryptocurrency, because they want to have money which will not have any government behind, right, for cryptocurrency. If it will be like that, then it will contradict its first aim of issuance. But we don't know what will happen now. Really, the world is moving very fast, and maybe there will be some model developed for that. So I don't know. But in Turkey, I can tell you, there is one bank which is issuing cryptocurrency backed with gold. Yeah, this one can be done. So to make it sure, more, how to say, compliant, economically compliant, and less risky. So you are buying, they call it 1 gram. No, 1 gram, no, 1 gram, I think it's in Malaysia. Biga. Here we call biga, 1 gram altın, biga, which is you are buying 1 token is backed with 1 gram of gold, something like that. But again, can we have government behind it? Time will show. I cannot give you very clear answer for this because it's still developing area. Thank you. And this question was from Madiba Dari. Thank you, Madiba, for your question.
Thank you, Madiba. Any question from another student or participant? not any question, we can finish this class with very, very thank you for you, Dr. Camelia. Really, we have you have got experience and we have more benefit today. So thank you very much.
Terima
Thank you.
kasih.
Terima
and
kasih.
Syukran
Everyone.
jazilan, Dr. Askar, and thank you very much to Dr. Dimas
Now,
also.
Dr. Dimas also, I think he heard us and heard Dr. Dimas.
Oh,
Assalamualaikum.
Assalamualaikum, Dr. Dimas. Apa kabar? You are here.
Yes.
How are
Sorry.
you?
Yeah, so I'm watching your presentation just now, Doctor. Very great presentations. Thank you, Dr. Askar, as well for moderating the presentations. Actually, I'm having a question with you, Dr. Kamila. If you please to take my questions.
Please, Dr. Dimas.
Yeah. I have two questions actually, because right now I'm doing a research on optimal level of Islamic banking contracts, looking at the vulnerability and shocks. So by looking at the optimal level, we wish that we can get the stability in the long run. But I'm using non-parametric approach, not parametric approach. So I'm using Excel and taking the calculation and a bit quite details and technical. And in the end, we are going to find out the threshold, the optimal threshold, so that by taking this threshold, so we can identify to what extent the portfolio that we have is going to be above or below or in the optimal position. So principally quite similar with your thought, actually, Dr. Kamila.
Yes.
So my question is, the first is, could you please show us the optimal portfolio, the optimal portfolio that you mentioned in the title just now? So what do you mean by optimal? So maybe I'm quite miss this information.
Very good.
And the second question, yes, the second question is, if we have if the position of the portfolio within the optimal positions, or you mentioned about the optimal level just now, does it mean that the stability of what will be created? It will be there, meaning that whether the stability of the fiat money currency or stability of gold, or what you mean if the optimal level has been reached? So this is just my humble questions.
Yeah, very good question.
So sorry for asking you so many questions.
No. I'm really happy. I'm really happy, and inshallah, I will try to answer you. Actually, at the beginning of my presentation, I already mentioned, I said we started with because I'm working with central banks reserves in this study. It's my PhD, you know, and I was asking, like, okay, we compared the gold reserves of Western countries, which constitute 70 and above % of their total reserves. And when we look to Muslim countries, it's just 1%. And in Turkish case, it's 16%. In Indonesian case, it was 4%. So we said, so what? Now it means that, and we're also looking at the performance of gold in the history. I also talk about my motivation, why I was so much interested in gold, because I told to students, now maybe I shortly repeat, I was born in Soviet Union. The country which faced collapse. I faced the collapse, literal collapse of the country and collapse of the currency. There was a Soviet ruble which collapsed, and we don't have anymore that money. And my parents, all their savings was in Soviet ruble, and it was a lot of money to buy 3 houses, house for each of us, for each sibling. They couldn't buy anything with that money, only 1 table, 6 chairs, because country collapsed, their savings just melt down together with country. On the other hand, my grandmother, all her savings was gold, and she became even richer after this big crisis. So that from my childhood was in my mind. So I said, now we as a country is keeping so less gold. All our reserves, 98% of our reserves are in paper money, which is USD. So I said that time, so now we need to increase optimal level coming here. Yes, you have to increase, but to what extent you have to increase? You have to increase 5%, 10%. What will be the optimal level? So when we talk about optimal level, it is this one. And now we are using Black Litterman model. Why we are using Black Litterman model? I also explained that before, for portfolio allocation, we were using modern portfolio theory developed by Markovich in 1950s. And Markovich developed such a model which doesn't have any intuition. It means when I am building a new portfolio, yes, there is asset allocation, but I am looking only to the past performance of all assets. I'm not looking at the future. I cannot look at the future, basically. I'm doing all my assumptions are based on the past performance of the asset and on the risk appetite of the investor. So according to that, I'm building model, new portfolio. But study shows that it's not practical and you cannot implement this model in real life. Then in 1991, two guys from Goldman Sachs, Black and Litterman, they developed this new model. Actually, it is improved version of Markovich model, Black Litterman model. They add something new. What was it new? Intuition, view of the investor. It means now, as an investor, I can say, or as a portfolio manager, I will say, yes, I think I have this asset, but I expect, in my view, that particular asset will really shine in the future. It will perform better in the future. And I also give you my confidence level, how much confident I am about that view, 50%, 60%, it can go up to 100%, from 0 to 100. 100 means I'm certain, which is impossible. You cannot be certain about future. So when I was building this, my work, of course, I cannot contact portfolio manager of central bank. It's impossible. I look at the performance of some assets which we have in the reserves, in our reserves, such as currencies and gold during time of global financial crisis. And I see that during financial crisis, global financial crisis of 2008, government treasuries of US, Japan and Europe, they all fall. Meanwhile, gold rise. Okay, then I put two views. In one view, I said that gold will outperform US dollar denominated assets by 4%, and my confidence level for both new views was 50%. And another one, the Japanese yen will outperform. So, and so now I have portfolio, existing portfolio. I have my views, new views, right? My expectation. I have their past performance, and putting all of them into the model will give me the optimal model, the optimal level, new level of each asset, considering my view and my expectation. So this is what we talk about optimal.
So in your case, yes, yeah. Sorry, doctor. So in your case just now, what is the optimal level that you mean in terms of the gold compositions in respective countries?
Oh, okay. Let me show you my slides again.
So just small questions.
Yeah. Okay.
I think in the almost last question, last slide. Last slide.
Like actually, here 4 slides because I
right. Yes. This one.
4 slides because I have 4 countries. I did this for Turkey, for Pakistan, for Saudi Arabia, and for Malaysia. Like for Turkey, see, this is current level of gold, 16%. And according to my model, my expectation, it should be increased to 36%.
So 36 here is your optimal.
This is my optimal. And I, considering past and also future expectation of the gold. So we see here, let me show you this slide.
Yeah.
When you look here, this is gold reserves and the share of gold in total reserves for USA, it's 75%. for European central banks, 32, Germany 72, Italy. But when we look at Islamic countries, say for example, Indonesia, it's only 3%. It means gold composition of gold is only 3% among all reserves. It means that 97% is in currency, in paper money. And the question was, what will happen if there is any problem in US, financial problem in US, and US dollar's value will fall? Like when we look at Russia, see how they're increasing their gold reserves.
Okay.
Same with China. They're also aggressively increasing their gold reserves. And but for Muslim countries, we a bit unaware of what is coming. So that was my work on that.
Okay.
And
so in case,
again,
doctor, so we have already reached this, for example, in case of Pakistan, we have 27%, for example, in terms of gold. So it does mean that if this country reach this 27%, it does mean that the stability of currency or stability of what will be maintained in this context?
Okay, very good. What will maintain in case of crisis? Okay, because we are preparing our central banks to face any possible crisis which is coming again and again and again. It's more and more today. So in case there is any crisis, you have to have asset, which is gold, will outperform the other assets in your portfolio. Okay, actually, if we are talking, I'm just looking at crisis. I'm not looking at black swan event, because collapse of Soviet Russia is black swan event. Same with COVID-19 is black swan event, and black swan event, you cannot predict it actually, and you cannot be prepared. That's why we call it black swan, right? So, but here I'm telling that in case of crisis, that's why I get as an example the performance of assets during global financial crisis. See how gold is outperforming on all government treasuries going down. So in this case, it means your portfolio will be designed in such a way that it will not, the value will not go down. It will not melt. It will still, at least you have to keep the same value of your portfolio.
So it does mean that the resilience of economy will be maintained if the goods reserve there.
Yes, exactly. Yeah.
Okay. Okay, clear. Thank you very much, Doctor and Brother Askar, for the time.
Thank you for your question, and thank you for your time, Dr. Kamelia. And when we started, we talking about subject exchange student, and this Dr. Dimas, head of program. So you take this talking with Dr. Kamelia, and
I was at the beginning while waiting for students. We were talking about, you have undergraduate level program. We have undergraduate level program here in Karatay University. Why we don't sign MOU? And we have the student exchange, staff mobility programs together, some research together. Because Malaysia, Turkey and Indonesia, we also have now a lot of work done on Islamic finance. Same with Indonesia on Islamic economics and finance. And I really be happy to collaborate. And
okay,
maybe
inshallah, we will follow up soon with you, Doctor. Inshallah.
Okay. Inshallah. Okay.
Thank you.
Happy to welcome you all here, inshallah, in future, in very near future.
Inshallah. Okay. Thank you for all participants. Thank you for Dr. Dimas. Thank you for Dr. Kamelia.
Thanks for inviting. Thank you for inviting.
Yes, exactly. We close this meeting with Alhamdulillah Rabbil Alameen. Wassalamu alaikum warahmatullahi wabarakatuh.
Assalamu alaikum. Take care.
Walaikum salam. Okay, thank you, doctor. Stay safe and healthy.
You too, doctor. Most important, stay healthy and safe, and inshallah, see you soon in other events. Okay, thank you again. Assalamu alaikum. Take care.
Salam.
I will share slides, yeah?
Okay.
Thank you, doctor.